They're not predicting a crash. They're preparing to profit from it. Right now, 76% of corporate insiders are selling stock. Warren Buffett is sitting on $325 billion in cash, the largest war chest in market history. Over $2.1 trillion in commercial real estate loans are maturing into a debt spiral. Regional banks are quietly collapsing. New York Community Bank lost 90% of its value in 8 months. And here's what they don't want you to know. While retail investors are still buying the dip, the same elite class that made billions in 1929 and 2008 is already positioned for the next collapse. This isn't a prediction. It's a repeatable 4-stage pattern. It's already in motion. And if you don't know where we are in the sequence, you're the exit liquidity. Let me show you exactly how the crash will happen, and how they're planning to get rich, while everyone else gets wiped out. 10. Delay the panic. How central banks quietly stretch the fuse while the clock ticks. Most people have no idea how manipulated the global financial system has become, not to eliminate risk, but to delay its detonation just long enough for insiders to exit the building. Central banks, especially the Federal Reserve, have mastered the art of postponing crashes, not preventing them. And that delay is exactly what allows the smart money to escape, while the retail investors stay locked in the house, thinking the fire alarms are just background noise. You want proof? Look at the interest rate cycle since 2022. The Fed hiked faster than any time in the last 40 years, 500 basis points in under 18 months. That's financial whiplash. But here's the trick. Even as rates skyrocketed, liquidity injections continued quietly behind the scenes. In March 2023, right after Silicon Valley Bank collapsed, the Fed created the Bank Term Funding Program, a stealthy bailout allowing banks to value distressed securities at full par value while pledging them as collateral. Translation: we know your assets are trash, but we'll pretend they're worth full price, so you don't implode publicly. And this was no small tweak. Over $150 billion flowed into zombie banks in under 3 weeks, artificially propping up their books. But while retail thought the banking system was rescued, insiders were already dumping regional bank shares, shorting commercial mortgage securities, and exiting REITs entirely. The delays give them time to buy volatility protection, time to rotate into safe havens, and time to write letters to shareholders filled with vague language about uncertain conditions. Meanwhile, you, the average investor, are still listening to CNBC hosts tell you that soft landings are increasingly likely. That's the goal. Delay panic long enough for the smart money to finish building their life raft while you're still inflating yours. The fuse is lit. The system is cracking. But the suppression of real-time consequences, through backdoor bailouts, statistical manipulation, like redefining core inflation to exclude housing, which is 40% of CPI, and carefully timed Fed speeches, isn't about saving you. It's about giving the elites enough breathing room to execute stage 1 and 2 without triggering mass hysteria. History has shown this again and again. Delay the panic, extend the illusion, and let retail investors hold the bag when the music finally stops. 9. The false boom. Why everything looks fine, right before the crash. Here's the part no one tells you. Some of the biggest rallies in stock market history happened right before everything collapsed. That's the deception phase. It's when optimism roars back, earnings surprise to the upside, and every financial influencer on TikTok swears the bottom is in. But here's what really happens in this phase. The false boom is engineered. It's the final blow off top, the sugar high before the coma. In 2007, the S&P 500 hit all-time highs in October, right before the worst recession in 80 years. In February 2020, markets were euphoric. Weeks before COVID shutdowns sent the Dow plunging 10,000 points. And now, as of mid-2025, we've just had the largest AI-led tech rally since the dot-com bubble. NVIDIA became the world's most valuable company. More than Apple, more than Microsoft. The Nasdaq is up 140% since the October 2022 lows. So you tell me, what does history say about melt-ups like this? They don't end in soft landings. They end in flames. The false boom gives everyone a dopamine overdose. Investors forget about interest rates. They ignore yield curve inversions. They pretend commercial real estate doesn't exist. Instead, they chase 50% gains in 3 months on chip stocks because AI is inevitable. But this optimism isn't organic. It's structurally manufactured. Corporate buybacks exploded in Q1 2025, over $350 billion, the highest on record. That's companies juicing their own stock price even as insiders sell into strength. Earnings? propped up by cost-cutting, layoffs, and accounting gimmicks like adjusted EBITDA that excludes stock-based compensation, interest, taxes, and basically all real expenses. And while stock prices scream higher, margin debt quietly climbs. Retail investors are once again borrowing to buy stocks, just like 1999, just like 2007. The smart money wants this rally. It lets them unload inventory. This is the exit pump, the melt-up phase where the dumb money thinks they've been vindicated, and the crash prophets were wrong. But the truth is, this is exactly what always happens. Final stage euphoria before violent reversion. The biggest traps don't look scary. They look like opportunity. The false boom is here. And it's bait 8, the illusion of diversification. Why the safe assets are set to implode too. You've probably been told your portfolio is safe because it's diversified. You own a mix of stocks, bonds, real estate, and maybe a little gold or crypto. You've got tech exposure and some defensive names like healthcare or consumer staples. Maybe you even hold a few utilities or dividend-paying blue chips for good measure. Sounds solid, right? That illusion? Yes, illusion is exactly what leaves most investors defenseless when the real crash comes. Let me explain. In theory, diversification is supposed to reduce risk. But in practice, in a systemic collapse, correlations go to 1. Everything crashes together. In 2008, U.S. Treasuries were the only asset class that didn't tank. But in 2025, even Treasuries are suspect. Why? Because the U.S. has added over $8 trillion in debt since 2020. Interest payments alone now exceed $1 trillion annually, more than the entire defense budget. That makes long-duration bonds toxic. As rates rise or even stay elevated, bond prices fall, especially the ones everyone has been told are safe. Just ask Silicon Valley Bank. Their collapse was caused by supposedly low-risk treasury holdings that dropped 20–30% in value. And real estate? We already covered the ticking time bomb in commercial property. But residential isn't immune either. With 7% mortgage rates, affordability has collapsed. First-time homebuyers are frozen out. Demand is drying up and price declines are accelerating in formerly hot markets. But here's the twist. Most index funds like SPY or QQQ are extremely top-heavy. The top 5 stocks in the S&P 500 make up over 27% of the index's total market cap. If just a few mega-cap names collapse, your diversified fund gets wrecked. And then there's crypto, promoted as a hedge against inflation. But when liquidity dries up, Bitcoin trades like a tech stock on steroids. Down 70% in 2022, up 180% in 2023, and now in a precarious no-man's land. It's not a hedge, it's a speculation vehicle. And in a crisis, speculations get crushed. Diversification works in normal conditions. But in stage 4 crashes, everything correlated to leverage, liquidity, or sentiment gets annihilated. The only true protection is uncorrelated assets, cash, short-duration T-bills, gold you can actually hold, and yes, some smartly placed hedges. If you're not rethinking your safe allocations now, you're walking straight into the meat grinder, wearing a blindfold and a smile. 7. The debt spiral nobody mentions. How government bailouts will trigger the final implosion. Let me tell you a secret most financial media won't touch. The next crash isn't just about overvalued stocks or failing banks. It's about the sovereign debt spiral, and the trap is already set. Here's what they won't say out loud. The U.S. government cannot afford another 2008-style bailout without triggering a bond market revolt. In 2008, when the system collapsed, the Fed and Treasury had balance sheet space. The national debt was under $10 trillion. Today, it's $35.7 trillion and rising by $1 trillion every 100 days. Let that sink in. That's $10 billion in new debt every day. And interest costs are now the fastest-growing line item in the entire federal budget. So what happens when the next wave of collapses hits in 2026? When commercial defaults explode, when regional banks start folding one by one, everyone will scream for stimulus again like clockwork. But this time, there's a catch. If the Fed slashes rates or starts QE again, bond investors revolt. That's what we saw in the UK in 2022, when pension funds almost blew up due to rate volatility. The Bank of England had to buy their own bonds to stop the collapse. If that happens here, if the Fed cuts rates into a $35 trillion debt load, the dollar will crater, inflation will roar back, and foreign buyers will dump treasuries. This is how confidence breaks. The debt is no longer manageable, it's metastasized. Foreign central banks, including China and Japan, have already reduced treasury holdings. They're watching. They know. And if demand collapses for U.S. debt, guess who becomes the only buyer left? The Fed. And that's when we enter stage 5, currency crisis. We'll get there soon. The trap is set. The next bailout attempt could cause the final implosion. The bond market has been eerily calm. But that's just before the hurricane. So while everyone's still focused on Nvidia's quarterly earnings, or whether the Fed will cut in Q3, the real game is playing out in the Treasury market, where trillions hang in the balance. And the fuse? It's already lit. 6. The quiet sell-off. Why your 401k is already bleeding and you don't even see it. Here's the dirty truth. Most investors miss. The crash has already started, but it's happening in slow motion, under the surface, in places your retirement account doesn't even look. You log in to check your 401k, and it still shows green. Maybe you're up 8% YTD. But that number is a mirage. Because while the S&P 500 headline index floats near record highs, the underlying breadth is disintegrating. You ever hear of the generals and the soldiers? Right now, the generals, Apple, Microsoft, Nvidia, are still marching forward. But the soldiers, the rest of the market, they're dead in the trenches. As of June 2025, over 55% of NASDAQ stocks are down more than 20% from their highs. Small caps? They're already in a bear market. The Russell 2000 is down 17% year-to-date, while the S&P is up 8%. That's called a bifurcation, and it's a classic pre-crash signal. The big names hold the index up just long enough for institutional money to quietly exit everything else. This isn't speculation. This is data. Insider buying is at a 12-year low, while insider selling is at 2021 highs. Hedge fund net exposure is at its lowest level since March 2020. They're pulling out silently, systematically. Meanwhile, passive funds keep buying because your 401k does it for you. Every paycheck, new capital flows into index funds, and those funds buy the same top 5 names that are already overweight. That's artificial demand, autopilot investing that keeps the illusion alive. But under the hood, your diversification is bleeding out. Sectors like biotech, regional banks, and consumer discretionary are already down 25% or more. Your mutual fund isn't showing it yet because the losses are smoothed out by the few tech winners still rallying. But when the generals fall, and they always do, that's when the surface cracks match the rot beneath. So don't wait for Jim Cramer to tell you a bear market has started. It already has. It's just hiding under the hood. The smart money knows this. They're not looking at index levels. They're watching internals. And the internals are screaming red. The job numbers lie. Why the labor market is cracking beneath the surface. Let me be blunt. If you're still looking at the unemployment rate to gauge economic health, you're using a map from 1950 in the middle of a GPS war zone. The labor market isn't resilient. It's artificially maintained by data manipulation and low-wage gig jobs replacing high-income careers. As of mid-2025, the official unemployment rate hovers around 4.1%. Sounds great, right? Until you dig deeper. That headline number? It's based on a survey that counts any work in the last week, even 1 hour, as employed. So the Uber driver who gave 2 rides and made $37 last Tuesday? Employed. The woman driving Instacart deliveries who lost her tech job last fall? Employed. But here's the kicker. Full-time employment is shrinking, while part-time and multiple job holders are surging. In April 2025, the number of Americans working 2 or more jobs hit an all-time high, 9.2 million. That's not ambition, that's desperation. And labor force participation? Still below 2019 levels, meaning millions simply stopped looking and no longer get counted. Meanwhile, corporate America is in silent layoff mode. They don't call them layoffs anymore. They call it headcount optimization, voluntary exits, and performance-based restructuring. In Q1 alone, Meta, Salesforce, and Amazon cut over 80,000 jobs combined, but the layoffs were disguised across departments to avoid headlines. And in the small business sector, it's worse. Surveys by the National Federation of Independent Business show that 42% of small businesses are reducing staff hours or shifting to contractors because they can't cover payroll. But the Bureau of Labor Statistics doesn't pick up these subtle contractions until months later. It's all lag. By the time the job numbers officially deteriorate, the crash will already be halfway done. That's exactly how it played out in 2008. In January of that year, unemployment was just 5%. By December, it was 7.3%, and nobody understood how fast it was accelerating until it hit 10% in early 2009. The signs were everywhere in advance. Corporate hiring freezes, rising jobless claims, collapsing small business sentiment. Sound familiar? If you're relying on the job numbers to tell you when to worry, you'll be 6 months too late. The smart money already knows this. They're watching hours worked, wage growth relative to inflation, and temp staffing indexes, all of which are flashing red. The labor market is cracking. You just don't see it on the surface yet. But beneath it, the floor is giving out. 4. The liquidity trap. Why the Fed can't print us out this time. Here's the cruel twist in the 2025 cycle that most investors haven't wrapped their heads around yet. The Fed is out of ammo. Yeah, they can lower interest rates. They can even try QE again. But this time, it won't save the system. It'll kill confidence. Let me explain. In 2008, when Lehman failed and the credit markets froze, the Federal Reserve slashed interest rates from over 5% down to 0.25% within a year. That was a shock absorber. Then they launched quantitative easing, buying up toxic mortgage bonds and treasuries to flood the system with liquidity. It worked, sort of. It stopped the bleeding. But it also created the biggest asset bubble in modern history, especially in stocks and real estate. Then came COVID. The Fed did it again, but even faster. From March to April 2020, they injected $2.3 trillion into the system. The result? The market soared 120% in under 2 years. But here's what no one wants to admit. That trick doesn't work forever. Because now in 2025 we're trapped. Interest rates are still above 5%. Inflation is sticky, 3.8% core CPI, and higher in real life when you account for food, rent, and insurance. If the Fed cuts now to stimulate during the coming crash, they risk inflation roaring back into double digits, and that destroys bond confidence. Foreign buyers of treasuries are already pulling back. China has cut its U.S. bond holdings to the lowest level in 13 years. Japan is selling. Hedge funds are demanding higher yields. The Treasury has to auction over $1.2 trillion in new debt every quarter, and demand is drying up. So if the Fed prints again, the dollar tanks, inflation surges, and the bond market seizes up. But if they don't print, the crash deepens. Banks fail, unemployment spikes, credit markets freeze. That's the trap. Any move the Fed makes now risks triggering a second crisis. This is what economists call policy impotence, when all your tools backfire. The market doesn't believe the Fed has control anymore. And when faith breaks, when investors realize the central bank can't rescue them, Stage 4 collapses accelerate into systemic implosions. The elites already know this. That's why Buffett isn't buying. That's why Druckenmiller is in cash. That's why Ray Dalio said in March 2025, the system is stretched beyond what monetary policy can fix. If you're waiting for Jerome Powell to save you, you're going to be very disappointed. 3. The passive time bomb. How index funds will accelerate the collapse. Let's talk about what might be the most dangerous weapon of mass financial destruction in the modern market. Passive investing. I know. Everyone says passive index funds are safe. Low fees, diversified, hands-off. But what happens when 70% of market flows are on autopilot, and the pilot goes blind? That's where we are now. As of 2025, over $12 trillion is parked in U.S. index funds. That's up from just $3 trillion in 2010. The big three, BlackRock, Vanguard, and State Street, now control more than 25% of the voting shares of the average S&P 500 company. That's a quiet monopoly. And the way these funds work is mechanical. You contribute to your 401k, the fund buys more Apple, more Microsoft, more Nvidia. Doesn't matter if earnings are down, debt is up, or leadership is questionable. If it's in the index, it gets bought. Sounds efficient, until it isn't. Because what happens when those inflows reverse? When boomers retire and start withdrawing? When fear sets in and people redeem shares? Those funds don't pick and choose what to sell. They dump everything based on weight, not fundamentals. That's forced selling. And in a panic, it becomes a feedback loop. Prices fall. More redemptions hit. More selling follows. It's liquidity death spiral 101. And because the top 5 stocks make up nearly 30% of the entire S&P, when they fall, the whole index collapses. But here's the real kicker. Passive funds have never been truly tested in a prolonged bear market, not 2020's V-shaped blip. I mean a multi-year unwinding like 2000 to 2002 or 1929 to 1932. These structures are designed for bull markets, not crashes. And when the next wave of withdrawals hits, and it will, as panic sets in, Index funds will become accelerants. The very thing people thought made them safe, automatic diversification, will make them the last to sell and the fastest to fall. The smart money already knows this. That's why hedge funds are not in SPY. They're in cash, volatility hedges, and select shorts. Passive investors? They're sitting in the back seat of a self-driving car heading toward a cliff, and they don't even know it. 2. The controlled burn. Why crashes aren't accidents. They're engineered exits. Let's stop pretending this is all just market forces. Let's stop believing that every crash is an unforeseeable accident. Because at this point, after 1929, after 2008, after 2020, if you still think collapses just happen without orchestration, then you're watching the financial system like it's a magic show, never noticing the wires behind the curtain. Here's the uncomfortable truth. Crashes are controlled burns, pre-planned exit events masked as chaos. And the elites? They don't fear them. They initiate them. Let me explain how. You think it's coincidence that right before the dot-com collapse, Alan Greenspan started aggressively hiking rates into a slowing economy? That's not bad timing. That's a controlled release of pressure, like poking a balloon to prevent an explosion. Same in 2008. Bear Stearns collapsed in March. The Fed bailed them out. But Lehman Brothers? They let that one go. Why? Because someone had to take the fall to scare Congress into passing TARP. Read Too Big to Fail. This was discussed behind closed doors. And now, in 2025, we're seeing it all again. Powell knows commercial real estate is rotting. He knows regional banks are leveraged to their necks. And yet, the Fed holds rates steady while liquidity tightens. They're creating just enough stress to force the weakest players out without triggering full-blown panic. You don't hear this on CNBC, but regulators know exactly which institutions are insolvent. They just don't announce it until the trap is sprung. Meanwhile, hedge funds and insiders quietly adjust their exposure, buy protection, and rotate into safety. They know the drill. It's like clockwork. But here's the most telling part. The media narrative always changes after the exit is complete. Right now, it's still all about AI optimism and soft landings. But when the crash becomes undeniable, you'll see the shift. Suddenly they'll say, the warning signs were there all along. Suddenly everyone knew. Too late for you, just in time for them. That's how controlled burns work. Set the fire, manage the fallout, rebuild on the ashes, cheaper, stronger, and with fewer competitors. The ones who panic lose everything. The ones who plan clean up the wreckage. You are living through a slow-motion controlled demolition of the overvalued, over-leveraged system. And unless you understand how engineered this really is, you'll still be standing under the scaffolding when it comes down. 1. The final transfer. How every crash ends with the largest wealth grab in history. Here it is, the final stage. The real reason this cycle repeats every generation. Because every crash ends with a transfer of wealth so large, so violent, so permanent, that it changes the social structure for decades. And it's already being set in motion. Let's go back. In 1929, the top 1% owned roughly 25% of American wealth. By 1932, after the dust settled, they owned over 45%. Why? Because they had the cash to buy assets when everyone else was liquidated. They bought land, businesses, stocks, and even entire towns at fire sale prices. Fast forward to 2008, foreclosures spiked. Millions lost their homes. Who bought those homes? Private equity. Blackstone, Cerberus, Apollo. They swooped in, bought 10,000 houses a month in bulk auctions, turned them into rentals, and now control entire neighborhoods. Today, BlackRock is the largest landlord in America. And guess what's coming next? As we head into 2026, over $2 trillion in commercial mortgages are coming due. Defaults are guaranteed. Banks will collapse. Office towers, multifamily units, shopping centers, all of it will flood the market at distressed prices. And who's waiting with record dry powder? Blackstone, KKR, Brookfield, Berkshire, the same players. But here's what's new this time. Tokenization. Yes, the next crash will involve digital ownership transfer, where assets are fractionalized, securitized, and sold through blockchain systems, controlled by, you guessed it, the exact same firms. You'll see entire apartment complexes tokenized and sold in pieces to accredited investors. You won't own the building. You'll own a share of a token representing a claim somewhere in the capital stack. Meanwhile, they own the deed. That's not participation. That's financial feudalism. The elite don't just survive crashes. They expand their control, acquiring what's real while the rest of us are handed virtual IOUs. And don't forget, Every bailout, every Fed intervention, every stimulus check comes with debt that you, your kids, and your grandkids must service. Your tax dollars pay for the same institutions that engineered the crisis. This is how it works. It's not new. It's not even hidden anymore. Every crash is a door, and when it swings open, the wealth doesn't vanish. It moves, from the poor and middle class to those who knew it was coming. That's what makes this the most dangerous stage, not the crash itself, but the cleanup, the aftermath, the final transfer, and we're standing right on the edge of it. The only question left is, which side of the transfer will you be on? This isn't a theory anymore. It's a countdown. You've seen the exits. You've seen the insider sales. You've seen the short positions. You've seen the cash stockpiles. You've seen the fuse burning. So now it's your move. You can sit in passive funds and hope this time is different. You can wait for CNBC to finally admit a recession is here. You can pretend the job numbers are real, the Fed has control, and your 401k will bounce back. But when the market falls 50%, hope becomes a luxury you can't afford. Or you can move now, before the panic, before the headlines, before the doors close. Hold cash, buy protection, make your list, watch for fire sale prices. Because the final stage of the crash profit pattern isn't just about survival, it's about transfer. And you will either be the one giving up your assets in a forced liquidation, or the one buying them for pennies with full control. History rewards the prepared, and it punishes the hopeful. The smart money already moved. Now it's your turn. Get ready.